blueprint in a course setting. So we do this every Friday night at 7 o'clock here, Alaska Standard Time, and it's about 11 p.m. Eastern Time. We know you're up because you're up probably. It's Friday night. You're not going to bed. You worked all week. You're probably doing something or hanging out at home. So if you're joining us tonight, thank you. And without further ado, let's give it up for Coach Jerry Fetta.
All right. Thank you, Mike. Good job. So if you guys are watching, what do we got? Instagram, Facebook, all of that stuff going on. So we're going to be talking the Wealth DynamX Blueprint. And we do have some special guests. It's awesome that you guys came up here. So we're going to cover basically, tell me where I'm at in the shot. Do I need to stand here? Good here? Cool. So we're going to be covering basically the steps you need to take in order to start creating wealth. If you're watching online and you're just seeing us for the first time, we do these every Friday night, 7 p.m. Alaska time. Like Mike said, that is like 11 p.m. Eastern. We know you're up watching Hulu anyways, so don't act like it's not happening. So tune in every Friday. These are free. We stream them online. You can also watch on the private webinar link. And our goal tonight is to provide financial education. So there's a lot of stuff out there, and not all of it's true. It's hard to figure out what's actually real from what's not real. And our goal is to give you, number one, certainty on what actually will work with your finances for wealth creation. Now, I want to stress our main purpose is for anyone watching. We want to inspire you to pursue financial knowledge. We want to inspire you to pursue, making more money, keeping more of it, and multiplying it, really with the end goal of, building a fund that's going to basically pay for a life of abundance and prosperity in all areas. Okay, so we all trade time for money. That's part of life. If you can incrementally remove yourself through that by acquiring assets that pay passive income, you can get your time back. So we're going to walk through that blueprint. Now, the last couple weeks, if you missed it, we have covered retirement accounts last week. We covered investing the week before in real estate. We covered the stock market, retail financial products the week before. And so this week, we're really going to cover, the blueprint, kind of the overall that you need to be focused on as you're creating wealth. And so I'm going to share my screen here for you guys. And then, Mike, can you guys see it on your laptop? Okay. All right, you guys should see that pop up right now. Is that good, Lexi? Can they see it on Facebook? Cool. So we're going to go through basically the blueprint. And so the first thing that this starts with is really making a decision. Okay, and so part of my story is when I started focusing on finances, I got in the financial industry at the age of 18. I just turned 27 on Wednesday. And so I've been doing this ever since. When I first got in the industry, I never personally made a decision to become wealthy. So I was teaching people about money. I was teaching people about finances, but I never actually had the conscious decision of this is a real thing, this matters, and I'm going to do it. My childhood, I grew up like in poverty. I think we were like 3 or 4 kids in the family, like less than a $30,000 a year income. We were on food stamps, food bank, all of that stuff. And so the idea of wealth, to be honest, wasn't real. Like I didn't know anyone that was wealthy. That wasn't something I had seen before. There weren't people that I could relate to and be like, oh yeah, that's like so-and-so. So the idea of, all right, well, I'm going to build wealth. Like that was something I had to really start to think about. What does that mean? And so the decision for me, it didn't happen till I was probably 21 or 22 years old. And it clicked for me. And I was like, this matters. And it wasn't until I learned how money worked. So when I learned how money worked, I actually got kind of pissed off. And we went over that last week with the banking thing. And when I learned how banking works and I learned how the economy worked, I got pissed off because I was like, that's slavery. I don't like that. And so I need to figure out a way to break free from that system. That's when wealth mattered. And I made the conscious decision, I'm going to start pursuing wealth now. And I would argue that before I had made that decision, I couldn't really even have helped my clients. Because if I wasn't pursuing it myself, how was I going to help Jeremy or really anybody build wealth for themselves? I can't teach Scotty how to build wealth if I'm not the one that's actually focused on it for myself first, right? So the first thing you got to do is decide. And to decide doesn't mean you selected something. Like when we think decide, we think, all right, well, I picked this option. Okay, well, if you picked this option, it also means you unpicked all of the other options. So if you go to the word decide, the etymology of that word literally means to cut off. So when you think about like cutting something off, like the rest of it's gone. Like if you lose a limb, I mean, you lost the limb. It's gone now. You decided not to have one, or maybe you didn't decide. Something else happened, right? But that's decide. So you need to decide to pursue financial knowledge. That's the first thing. And the mistake a lot of people make is they decide first, I want to be wealthy. And then they immediately think, all right, well, I'm going to pursue investing. Okay. And I know a lot of people, including myself, that can tell you if you don't pursue knowledge first, the investing part is very expensive and not very fun. So pursue the knowledge, try and win at the knowledge first. So that way you don't have to make the mistakes. Because you can read like most of the stuff, I'm going to give you guys a tip. Most of the investing stuff that you need to know is in really old books from dead people. It's not on like flashy webinars about how to get rich and sell e-courses. Like that's not where you're going to get the knowledge. Go read about Andrew Carnegie. Go read about Rockefeller. Go read about Warren Buffett. He's not dead, but the guy is very old. You guys get my point. That's the real data. So if you're reading about like, hey, I'm going to start investing and it's like this stuff you're seeing online, a lot of times that's not real knowledge. They're just trying to sell the course. They're trying to sell the event. They're trying to sell the ticket. That's why we don't charge for our courses. Come to the course and check it out, get the knowledge, and then we'll help you plan it out and actually make it happen. You also do need to decide to make more money. Okay, to make more money. And a lot of people don't like this one because we have this weird sometimes mindset with money that it's dirty and nasty and like, you know, it's the root of all evil and all this stuff. Remove like the emotional attachment from the equation and just think about, I'm trying to invest because I need to build wealth and I can't do that with nothing. And if I could be wealthy on my current income, it would have happened already. So by definition, if it hasn't happened yet, I don't make enough money yet. And in order to actually invest, you do have to save. In order to save, you have to increase the income. There has to be a surplus there. So if there's no surplus, it doesn't happen. Now, the next one is very hard for most people. You have to decide to keep the money. Okay, I know people that can make tons of money and they don't keep any of it. And you just make it and make it and make it, which is a talent and a skill and it takes creativity. But if you don't keep it, then it can never go anywhere. Like it's the classic, like, you know, guy that makes $250,000 a year in sales, doesn't make any of that money go somewhere other than expenses and his house and his car and all of that stuff. And at the end of the day, nothing's being saved. So you have to keep trading time for money. And it's easy to get caught up in like the fun or the novelty of having a lot of income. But at the end of the day, like if you forget the reason you pursued wealth in the first place, which was financial freedom, then you start to realize like, all right, well, I'm spending money on this stuff. It's not actually making me financially free. It's not actually moving the ball forward. So you have to keep that at the forefront of your mind at all times. My goal is financial freedom. That means that I don't get the house. I don't get the car. I don't do the trip. Instead, I find ways to get another asset because for the next 10 years, it'll be tough. After that, I can finally have freedom because I've got the assets now. And then last thing, you have to decide to multiply money. Now, we talked about this last week and the week before, so I'm not going to hit this too much. But again, if you're committed to multiplying money, the first thing you have to do is not lose the money. Any number multiplied against zero is still zero. Therefore, if you lose the money, there's nothing to multiply. So when we talk to our clients and stuff, we don't recommend speculative investments. We don't recommend appreciation-based investing. It's get a thing that's never going to go anywhere and make sure it pays you every month. You can multiply out that. If it's a zero, you can't do anything with it. Okay. So again, you have to decide. And the note at the bottom here, decision is not interest. Okay. There's a difference between making a firm decision, like I'm deciding for something versus just having a strong or mild interest in something. And I think a lot of people think decision is the same thing. Decision is like decisive. I'm cutting through. I'm going that direction. And all the other directions I'm going to get rid of. Interest is like, I'm going to check it out, see if I like it, and then I'm going to go back home. Okay, kind of like Scotty and Shelby, they're checking out Alaska. It does not mean they moved here. There's a big difference between we decided to move to Alaska, we're visiting Alaska. Nano decided to move to Alaska. It's a very big commitment.
I checked it out first.
You checked it out first. So that's the decision thing. So the next thing we're going to talk about is making more money. Okay, once you've made the decision and you started to get the knowledge, that's the first thing, getting the knowledge. Then it does come down to application. Okay, who knows somebody that they study stuff, they never apply the stuff they study? They're freaking brainiacs. They know everything about everything. And you're like, dude, how have you never done any of it? So like actually applying the information, if you're studying money, you should start accumulating it. You should see your income go up. You should see that you're making more money. So making more money short-term. And this is one that literally anybody can do. And I recommend doing it like on a weekend, 30 minutes, block it out and make it happen. We call it the 1 to 5 game. So you're looking for how do I make short-term money? How do I make short-term money? We're not thinking scale right now. We're just thinking about how do I increase the income, A, to get the income, but B, to prove that it's true. It's a real thing that I can do. Because if I can cause it, then I can cause it again. So I'm trying to see evidence, right? So we call this the 1 to 5 game. And we talked about this, what, a month ago, Nano? The 1 to 5 game? I think it was about a month ago. 4 weeks ago. Okay, so you're going to go through like every possession you own, and you're going to rate it on a 1 to 5 scale. Okay, 1, it was a dumb idea. Okay, we've all had dumb idea purchases. If it's a 1, you're going to sell it. Doesn't matter where you sell it. Doesn't matter who you sell it to. Instantly, you sell it. 2 was just bad timing. Doesn't mean it was dumb. It just means I don't need this thing right now. Okay, and you sell 2s as well. And you get rid of it any which way you can. A 3 is a maybe. That means that there's an emotional attachment to it. You know it's probably a 1 or a 2, but you don't want to admit it. It's really a 3. Put that on the back burner. We'll come back to it. 4s you don't sell. Those are vital for survival. So obviously you don't sell like the roof over your head and like I'm homeless so I can go invest in real estate. So you want to keep your 4s, and then your 5s are income producing, or they give you a tax benefit. You never get rid of a 5. Okay. When you've done that, then you can come back, revisit the 3, sell the 3, and then make the decision. I'm going to keep that income. So you could do that like instantly. Nano, you did that when you moved up. How much did you make when you did that?
Well, overall, a couple of months at close to 10,000, like 9,800.
Yeah.
Close to 10,000.
And how difficult was it?
I mean, so whenever I made a decision, I mean, it was easy, from the get-go. It was difficult trying to sell stuff. I was here. Like,
yeah.
With, a little bit of time zone difference. But the difficult part is making the decision.
Yeah. So when he decided to do it, and the proof is in the pudding, if Nano can do it from Alaska to Texas, literally selling stuff across the country, you can do it too. Like there's no excuse not to. So what this does is it gives you really quick cash. So you'll see 10 grand show up. Boom, money's in the bank. I'm good. I just proved I can do it. Okay. The second phase of this, and this one is actually ongoing. You now start doing this with your expenses. So you rate your transactions on a 1 to 5 scale. So if you track your budget, let's say weekly, you should look at it weekly, every 7 days. And it doesn't mean you're like penny pinching, but it means every 7 days you look at the list and you look at, was it income producing? Was it survival based? Was it a maybe? Was it bad timing? Or was it just dumb? And if it was just dumb, I get rid of it. If it was bad timing, I get rid of it. If it's a maybe, I'll make that decision, but I'm probably going to get rid of it. Keep the 4s, keep the 5s, and you'll start seeing money coming back in your budget every month too. Okay. And that's going to be with your expenses. Now, on that note, there's one that we have that's called DITI. Okay. DITI. And as part of your ongoing budget, these are fixed recurring expenses. It's debt, insurance, taxes, and investments. Okay. So when you sit down, like we work with families all the time where we sit down and do a wealth creation formula with them, and we'll look at what's your debt, and we find out one thing on the debt. People are insolvent, but they're trying to pay their debt off early. And it doesn't take too much thinking to think about, well, how did someone acquire debt? They didn't have money. So if I put all of my money towards paying off debt, I haven't solved the problem of no money. I'm going to pay off my debt, and I'm going to end up right back in debt because I didn't solve that issue. So lower your minimum, your payments down to just the minimum while you're in this stage. That's going to free up cash flow. You can start banking money, setting it aside, and getting solvent. Insurance, same thing. Look where can I cut costs? Which deductibles can I raise? Which insurances do I actually need? And cut those costs as well. Taxes, that's looking at what are my withholdings. Okay, so how do I lessen the amount of money that's withholding by maybe increasing my exemptions? Are there things I can deduct? Are there assets I can depreciate? Those are all things on the T, on the taxes. And then the I is my favorite one to pick on. If you're not wealthy yet and you're trying to figure out how do I save money, do not put your money into investments. Your 401k, your Roth, you don't get to touch those till you're 60. So if you're like, hey, I'm trying to stack up money to maybe pay off debt, or I'm trying to stack up money to invest in an asset, you do not need to put $300 a month into an IRA. So if you cut that expense, usually when we work with families, we're able to help them like find about $1,500 per month just in those 4 areas. And that frees up cash flow. So you've got that money back, and then you're looking again, selling everything that can generate income. Okay, you're just getting rid of stuff because you can always buy it back later. But at this stage, like you're focused and you did make that decision. Now, again, this is not an emotional exercise. So if you come from a place of emotion, you're going to be like, man, I really like that thing. You know, I remember when I first got it and it was awesome and I don't want to get rid of it. It has sentimental value. You can go get it again later, but you need to be focused on how do I just get the income up right now? Okay. So that's a true commitment to making more money. And notice we haven't said anything about like starting in sales or starting a business. That'll come later. This is just like in 2 weeks from now, how much money could I get? In a month from now, how much money could I get? Okay. Now our next slide is gaining financial control. Okay. So notice we said make the money first, then gain financial control. Most people flip that. So they think about like, how do I budget and gain control? And then later on, they're like, oh crap, I need to go make more money. Realize if you're not making enough income right now, or you're not saving the money you need to, you can't budget your way to that number. There's no way to do it. You have to do the income first. Once you have the income, then you can start to organize it and do things with it. Okay. But basically, like if you think about the budget concept, like sure you can do it, but how low do you want to go? We could do homeless. We could do no phone bill. We could do no car. But it really is that what you're trying to accomplish? Are you trying to accomplish low expenses? Are you trying to accomplish cash flow? And if you're trying to accomplish cash flow, you pop the income up first so you have the income. Then you go clear out all the wasteful expenses. Okay. So gaining control of your finances. So this is going to be like a weekly activity you want to do. The first thing you want to look at is you should have a weekly income target. Every week you're like, this is my number. I need to earn this much per week. You know, if you're hourly, then that translates to hours, right, Scotty? How many hours do I put in? If you're in sales, then it's how many people do I talk to? How many deals do I close? And that's the number every single week that you're focused on. Where's that money coming from? Okay. And once you've got that down, you're starting to hit that number. You then look at what are my expenses each week. So when I first started doing budgeting, it was very difficult for me because it was hard to manage and understand. And it was because I was dealing with too big of a chunk. So I was budgeting for the month, which is like, you should have a monthly like idea of what you're going to spend, but really you don't operate in months. So much can change in a month. You operate in days and weeks. So if you're operating on a monthly budget, what you want to do is actually multiply that times 12. So you know for the year what you're going to spend, and then divide that by 52. Now you've got a weekly number. This is how much I'm going to spend this week. Now, it's not even just how much I'm going to spend this week. This is my stop loss. This is the minimum amount of money I can earn this week. Because if I have to set this aside into my expense account every single week, the income better be there. I better have the money to actually fund that weekly expense. Okay, so it gives you better management over the finances because you're being more proximate to it. Okay, in business, when I really care about a number, I look at it more often. I'm more frequent. If it's revenue, if it's sales, if it's hires, whatever the number would be, I'm going to look at it really frequently. I'm looking at it all the time. My investments, I look at them all the time. So if I'm looking at, all right, well, I'm trying to gain financial control, then I would more frequently look at those numbers so that A, I've got better control over it, but B, there's less room for surprises to happen. And this is important to do, especially for scale. When you scale your investments up and it's not just you running them, you'll hear a lot of people say they look at their money every week. So that way, when they've got employees running the deal for them, if someone steals from them, they've only got 7 days to get caught. If you only look like a month, like someone can be out of the country. You'd be like, I don't even know that guy's real name. I don't know where he went. The money's gone. But if it's 7 days, like I can check and be like, hey, the number should be this. It's actually this. What happened? And I know that sometimes that can be like an unreal thought, but think about when you do have millions of dollars in investments and properties and businesses, you're not hands-on, you've got employees. Like one of the biggest risks is not volatility, it's getting stolen from. So how do I make sure that that's not happening? Okay. So that's going to be every week. Again, we talked about the DITI thing. And again, this needs to be an immediate activity and it needs to be done with urgency. This is not like a fun activity that you're going to do and be like, oh, I really enjoyed looking at my transactions this week. But it needs to be like something you understand. This is important. I'm going to put intensity into it. I'm going to make sure it happens. It's scheduled. I'm going to get it done probably 20 minutes of time. And then I can go on to the important stuff during my week for the rest of the time. Now, after we've gained financial control, this is the next step in the blueprint. You have to get really good at saying no. Really, I mean, you have to become like a connoisseur at saying no to stuff. Lexi, how good am I at saying no to purchases? Excellent. I'm very good at saying no. So you're not going to make money by yesing everything. You're not going to build wealth by yesing everything. So some of the things you need to say no to. Okay, so realize first, the wealthy, they got wealthy by saying no to the stuff that didn't matter. You need to know, what are my productive things, my top 20% activities, investments, ideas, and I say yes to those. The other 80% doesn't mean it's wrong. It just means I say no to that stuff. I've got priorities. So that's the decision thing. So you're saying no because you know your goals and purposes clearly. Someone that always says yes, they don't know their goal. They're operating out of boredom. They're operating out of mild interest. They haven't made the decision yet. So when you made the decision and you're like, hey, I'm going to, like, imagine boarding the flight, I'm going to Alaska, and they're like, sweet, we're going to Georgia. And you're like, well, no, that's not Alaska. I'm going to Alaska. Like, you would say no and you get off the flight. Now, if you didn't care, you'd be like, yeah, that's cool. Let's check out Georgia. You wouldn't get to your destination. No different than how money operates. So you're saying no to any financial decision that goes against your goal. And if it's not going to move forward towards your goal with little to no risk, it's not something that you want to say yes to. Okay. And examples of this, the easy one is obviously expenses. Saying no to expenses that aren't going to contribute. And again, it doesn't mean like beans and rice and live on nothing. Because when we say fours for survival doesn't just mean I'm barely getting by. Like, survival means that I'm actually operating at a high level. If I was a vehicle, like, I'm taking care of myself, premium fuel and gasoline, I go in the garage every night, like, I actually like do the right stuff, because this is a high performance plan. So you're not saying no to things to just be like frugal. You're saying no to things that don't logically help you make progress. So for me, like eating organic, that logically helps me make progress. I know that if I'm putting better fuel in my body, even though it is more expensive, that's not something I'm going to say no to. Okay, now fast food, all right, I can easily look at that one and be like, nah, that's going to give me low energy. I can say no to that, right? So you're saying no to expenses. You're also saying no to income opportunities as well. At a certain stage in the game, if you brought on a new income source that didn't really mesh well with what you already do, that could derail you. So you got to say no to that. You're saying no to maybe investments as well. Like, if you know your investment plan, especially if you've got money and people know about it, all of a sudden they got ideas all the time. They're like, man, you should check this out. You should check that out. Like, you should never invest based on checking something out. You should know. Like K-N-O-W, not N-O, right? You should know. So if you know for sure, then you're going to say, no, that's not my deal. I'm sticking to this because this is the plan. Like, we didn't get involved in the cryptocurrency thing at all because we're like, that's not, like, A, you could lose money. That breaks rule number 1. B, I can't really understand it. That breaks rule number 2. C, there's no cash flow. So that breaks rule number 3. And there's nothing backing it. That breaks rule number 4. So I'm not going to do that deal. That's a no. But it's because we understood our principles. We knew our goals. These principles help us get to the goals. Okay. So again, no ideas, no speculation, no distractions. And you don't just need to lose money to make the plan fail. You simply need to be slowed down. So that could be a distraction. I didn't lose money, but something like derailed me and slowed me down. Now I don't make progress as fast and things aren't happening the way they could be now. Now, the next step we're going to hit in the blueprint, this is the second phase of earning more income. Okay. So the first phase, that was just quick. Like, we need to get money fast. The second phase is actually sustainable. You're thinking about, how do I sustain my income? Okay, because I can't sell stuff out of my garage forever. I'm going to run out of stuff. I can't just over budget forever. I'm going to finally like get my expenses in line. I won't have those bottom line expenses. So I need to think about, how can I actually increase my income long term? And this can be a tough call. Sometimes we have like the job that we trained for, we went to college for, we have that job forever and always. And I've had clients that looked at it and they're like, shoot, the job's not going to get the job done. So they start looking at, do I have to get a new job? Do I add a side hustle? And that's really where you have to start being like very intentional and very purposeful with where you're going to spend that time. Okay. So the first thing is, you can't make money just selling stuff. You need to be thinking about, what could the extra income be? If you can do it at your current place, that's the best, because it's not going to take extra time to travel. It's not going to be extra work. It's not a new skill set you have to learn. So if it could just be, hey, I can earn extra money on hours, or I can get a bonus, or I can earn more commission, that's the ideal scene, because it's not going to take a bunch of extra energy to be expended to get that income. Okay, where people get burnt out is, they're an engineer and that's a 50-hour-a-week job. And then they're like, also, I'm going to sell real estate on the side. Terrible idea. Okay, you have to be focused on, all right, if I'm an engineer, Like, how do I make that work for me? And if I did start a side hustle, how do I start a side hustle that capitalizes on that skill? Because that's the skill I'm good at, right? So when you're picking the next flow, like the next source of income, there's a couple things you do need to answer for yourself. And there's not like a magic one you pick. Like, people ask us that all the time, right, Nano? They're like, what should I do? And we're like, I don't know. Sell something. What should I sell? I don't know. Pick one. It really doesn't matter. But what you do need to understand is, number one, it's got to be ethical. So it's got to be ethical. You've got to be fully able to get behind it. Okay? And it's also got to be not poisonous. Right, Nano?
Exactly.
So last year, you guys know what a gooey duck is? Do you know what it's like what is it, Mike? It's like a clam thing. It's like a sea cucumber clam that like spits water out. So I texted a picture of it to Nano. I was like, Nano, you should eat one of these. And his response was, as long as it's not ethical or poisonous, you're good. So same thing goes for your new flow income. As long as it's ethical and not poisonous. The second thing you need to look at is, does it have margin? Okay, so margin would be like the profitability. When I do one unit of that thing, whether that be hourly, whether that be a sale, do I make enough per hour or per sale for it to be worth my time? Okay, because the margin, that's the thing you're going to multiply on. If I can't have margin, then I've got to sell tons of those things, or I've got to work tons of those hours. Okay, so if I'm working a job and I'm like, hey, you know, I'm working 60 hours a week, let's say, but I'm making like $75 an hour, that multiplies really well, right? But if I'm making $7 an hour, 60 hours doesn't sound cool anymore. So my margin has to be there. Now, the next thing is, if you're selling on commission, it actually has to have margin on the sale too. So if I'm like selling candles and I make 30 cents a candle, for us, it's bullion, right? We sell bullion. We don't make anything because it's spot price, right? So you couldn't just be like, that's the thing I'm going to sell. You would have to sell tons of it to actually make any money. So you need to be looking at what's the actual margin on the deal. Second thing is volume. Can I repeat the activity? Okay, is it scalable? Is it something I can do over and over and over? So if it's like, you know, let's say it is hourly, can I just commit to my hours and do that over and over and over and repeat it and have that actually be like a scalable system? Or if it's a sale, is it a product that everybody wants or enough people want that I can build a niche and actually sell and continue to repeat it? Okay, and that's why this is the second phase. The first one, selling stuff out of your garage, that's not volume. Selling your possessions, that's not volume. That's quick, that's margin, but it doesn't have the volume factor, which is why we do have to replace that later. And then after we've got that, you've got to look at if it's going to be scalable, is the right leadership in place. Okay, who's ever worked at a company where the leadership sucked? Management was off, the vision wasn't there, the passion wasn't there, disorganized, bad communicators, etc. So the margin could be there, the volume could be there, it could be ethical, but the wrong leadership is in place. And because of that, the vehicle is not going to go where it needs to make stuff happen for you. And I would add, sometimes the leadership that's in place and is wrong could be you. So not everybody should be an entrepreneur. Sometimes if you have an experienced company that has the right leadership, that could be a quicker route than being like, hey, I'm going to go do my own thing. Okay, because for me, the first probably 4.5, 5 years of business, when I was my own boss, I was the worst boss I ever had. Okay, it was not a fun thing. And I was like, man, I'm my own boss. I have freedom. I can do whatever I want. Yeah, I could, but like if I had goals, I couldn't do whatever I wanted. I had to be committed to whatever those goals required of me. And so you have to be able to do that if you're doing your own thing. If you're in a company, you need to have a leadership in the company that's willing to do that as well. Okay. And then the last thing is, does it interfere with the primary income source? Does it interfere with my primary income source? And if it interferes with my primary income source, it's an automatic no. Because my primary source, even if I hate it, it's the thing that produces for me right now. So you never give up on known income for speculative income. I'm not going to quit my job that I know is paying me to go try something that I've never proven myself at before. I keep that income until I've actually got, ideally, let's say it is a side hustle. I've leveled that side hustle up to where it earns the same amount or more money than what I currently do. And I can finally just unplug and leave, and I don't even notice the difference. And I just put in the extra time on my evenings, my weekends, my early mornings until I make it happen. For me, it was actually a pizza job. Not many people know this. I did pizza delivery for a very long time in the evenings while I worked my business in the daytime. Before that, I was a head personal trainer. Awesome job. Made a good wage. It was perfect, but it required too much of my time. So when I was serious, I made the decision about my business. I broke the rule. I was like, hey, I have to quit this job because my business can't grow if I'm working at the gym during the daytime. I need to find something that can just pay bills and I can do my business during the day. Okay, and I was good at sales, so I knew how to get tips too. I was very excellent at getting tips. And then I bought, what do we have, a Geo Metro? Anyone know what a Geo Metro is? They get like 60, 70 miles to the gallon. So $5 in gas, $180 in tips. I was good. I knew my margin was there. Okay, so that's really like the answers you want to keep in your head as you're going through these steps, making sure you're focused on them at all times, because it's easy to get distracted. There's network marketing out there. There's business opportunities. There's e-commerce. There's all of this flashy stuff, and it's not wrong. It just might not help you. And if it doesn't help you, then you don't need to get involved in it. Now, once we've got the income up, we've scaled it, this is where you focus on the sacred account, 40% rule. Okay, the 40% rule, and where we get the 40% rule from is if you study the top 1% of wealth for the last century, they've saved 40% of their gross income. 40% of their gross income. That means if you make 10 grand a month, you're taking 4,000 off the top and you're putting that in savings. Okay, and it's not the rainy day fund. This is the fund that you're going to invest from. And what you'll see in the trend is they'll save 40%. And then when you look at the graphs on this, you'll see like the Great Depression happen. Their savings rate not only dips, it goes below zero. They actually go in debt during the Great Depression. And the reason why is they're taking all of that money and all of that cash flow and they're buying everything, stocks, companies, real estate, because everything just went on sale. Depression's done, they're right back up at 40%. It happened again in the 50s. It happened again in the late 70s. It happened in 2001, 1999 through 2001. It happened again during the mortgage crisis. You'll see it like clockwork. Every single time there's a recession, their savings rate dips. And as soon as the recession is done, it's right back up at 40% again. So if there's one rule you learn, this is, I call it the linchpin. Because if you save 40%, you got to earn a lot of income, right, Scotty? So it's almost like we used to pull sticks in my sister's farm. So we'd tie ropes around each other and tie it to the back of the truck and see who could run as fast as the truck could. That was the fastest I ever ran. Because if I didn't run that fast, I was going to get drugged through the mud and the sticks. The 40% rule does that to you. If I commit, I'm going to stick 40% in this account. Guess what? I better go make the money. So it actually propels my income up because I don't have a choice but to go fund the account. Okay. And then the other thing it does is it does give you options. So again, this is not like emergency fund or rainy day fund. This is, I've got a ton of money put away that I don't feel like I urgently need to put anywhere, but when the opportunity comes up, I can go grab it. I'm the guy that has the cash. I'm the guy that has the capital. And that's always the person that's going to be the best investor. It's the one that doesn't have to do anything. If you've got 500 grand sitting in cash, even when you look at investments, you're going to be like a pessimist. You're going to be like, this is $500,000. I'm not just going to throw it into anything. I'm going to be very picky. I'm going to inspect the deal. Versus if I'm doing 5 grand, you're like, yeah, 5 grand. I'll go make it back, over the next 6 months if I lose it. So there's not the same amount of care there when you get to the investing stage. So we've heard this phrase, right? It's not what you make, it's what you keep. Okay, we actually added to that. It's not about what you keep, it's about where you keep it. So as you're saving 40%, if you're putting 40% in the wrong location, it's not really going to help you. If I put 40% in my 401k and I'm 27, that's not going to help me till I'm 60. Okay, I plan to do a lot of cool stuff before I'm 60. So if I'm locking that money up, like I can't do anything with it. It's done. I'm out. That's off on the sidelines now. Okay, if I put 40% in a bank, yeah, I have the liquidity, but cash is actually a liability. It's ironic. If you put it on a balance sheet is assets minus liabilities. For a consumer, cash goes in the assets column. Jeremy, where does cash go in a bank on their balance sheet? Liability. If they have cash, that's someone else's cash. They don't want the cash. They want to lend it out. So they've actually flipped the balance sheet. The debt now has become the asset. The cash has now become the liability. Why? Because banks understand money is going down by 4 to 12% in annual value every single year. So they know that because they're the ones causing it. So they understand if I have this money and I don't lend it out quickly and earn more than that 4 to 12% spread, then it's a liability. It's going to go down in value. No different than a car, no different than a pair of shoes. It's not an asset. Okay. So if you stick it in a bank, you're converting your cash into a liability. If you stick it in a 401k, IRA, et cetera, you're locking it up. And so we recommend the sacred account. Okay. And the sacred account is a concept where you set aside money for a purpose. And the purpose is cash flow. So if it's not cash flowing, you're not going to do it. It doesn't make sense for you. If it is cash flowing, then you look at the numbers and you're like, okay, this actually makes sense. I can now access the sacred account, put the money into the deal. That's why it's called a sacred account. It's just for that. Okay. So saving money, like we said, is the linchpin. And then the other benefit on this, guys, is it is a forced savings plan. So I hate 401k plans because it's just a terrible idea. But there are some people I meet where I realize if you didn't have like every single month money going into your 401k, you would be broke. So having that forced savings plan, it creates the effect where you don't have to make a decision every single day. You make the decision once. And then you just let the decision play out because every single month it's pulling money into the account. It's not something I can choose to do or not choose to do. And it's not something I would want to choose against. So if there's a risk that I would take that money and do something else, I need to take that risk out of the equation by ensuring it happens anyways. It's the same concept. The wealthy people, when they pass away, most of them put their money in a trust. And when their kids or their beneficiaries or their heirs get the trust, there's rules. The rules outline you can only use the money if you're going to do these things with it. Anything else is off limits. And the reason why is they know as soon as human behavior can enter into the equation, mistakes can happen. So they make the decision once. Like if you look at the Rockefeller Family Trust, that thing is still kicking, guys. It's been around for like over a century now, and it's still going. It's still funding public works. It's still paying everyone in the Rockefeller family. If you look at, it's actually kind of funny, the Forbes list, is it 500 or 400? The top 400, I think, where they measure the wealthiest people in the world. There's only one Rockefeller on the list, and the guy's like worth $4 billion. And they're like, man, where'd all the Rockefellers go? It's because all of the money went into the trust. The trust is not on the Forbes 400 list. That's only for individuals. So the wealthy understand, I'm going to put this money into a safe location. I'm going to make a decision once on how the money is going to be spent. That decision will be managed by the documentation of the account, and it's going to stay protected because of that. And that really is how it has to go. Now, the other thing is with the sacred account is you're going through it, you're using it only for investing, right? So the concept of investing, you have to earn cash flow first. Number one, don't lose money. Number two, always earn cash flow. So I put the money in my sacred account and I start looking at investing it. I need to understand, all right, well, there's profitability within the cash flow. Just because something has income doesn't mean it's profitable. So one of the benefits of using the sacred account for savings is when you access the money, you have to borrow it. And when you borrow it, you have to pay interest to your account. Which means if I borrow the money from the account and the deal doesn't make more than it costs me to borrow, I don't do the deal. So it's a safeguard against negative cash flow. Okay, if it doesn't cost me anything, if there's no penalty and I borrow and I'm like, man, I could flip this place up and get it going good, like that's a mistake waiting to happen. So what I'm doing is I'm actually creating an arbitrary that actually like produces a penalty for me, even though it's not naturally there, and it causes me to make the money go right with that account. It causes me to look for that spread on profit and margin. Okay, now the other thing that's kind of cool is when you use the sacred account, when you borrow the money out, it still grows. So imagine sticking money in a bank that's going to pay you 6%, and then you're like, all right, cool, I need to take a deposit. You take your deposit out, or you take your withdrawal out. You start, you do whatever. Let's say you invest it, and then you come back and they paid you interest even though the money wasn't there. That's what banks do. Not for us. That's what they do for themselves. They're able to take money that's not in the account and earn it because they can lend it out 10 times on the dollar. There's only two things in the world that allow you to do that. It's the sacred account and it's real estate. Okay, with the sacred account, I can leverage the account. It's still going to grow while I use it. With real estate, I can leverage debt. I can take $1, I can turn it into $4 or $5 and get cash flow from those dollars. But I can't do that. I can't do that with a mutual fund. I can't do that with a 401k. Do you guys want to know what's ironic? If you go to Jeremy as a lender, so vouch for me on this, Jeremy. If I go to you with real estate and I ask you for a loan and I have good credit and a down payment, I'm probably going to get a loan, right? Depends.
Oh, yeah, but yeah.
Logically speaking, like it should make sense, right? Now, if I went to you to go buy stock or mutual funds and I wanted to borrow money from your bank to do that, would you let me? Nope. The bank won't even touch it.
Even for their own stock.
Even if it was his bank stock. Like, come on, guys, it's your stock. I'll buy your stock, I promise. They still are not going to lend me money. Yet if you go to their financial advisor, the dude will sell it to you. He'll sell it to you all day, but he won't lend the houses money to buy their own products. But if you do that with real estate, they'll do it. Guess what? If you do that with life insurance, they will do it. Banks will lend money for you to buy a sacred account. It's called premium financing. They understand the spreads. They understand the benefit. They understand that they want to be a beneficiary on a policy. So you have to look at, like, if there's one business you should model, it is a bank. Okay, there's a reason why banks are so profitable. There's a reason why they do things the way they do them. All of the stuff we've talked about tonight, these are practices that banks put into play. Banks, when they started, they made a decision. It's called the bank charter. They made a decision on how they would operate. Okay, they look at how quickly can we churn and get income. That's where their account fees come from. They lend money out. They do whatever they can to get income. And then they manage the finances very tightly, especially if you're going to do the loaning thing. It's called fractional reserve banking, where you take $1 and you turn it into 10. You better have a really good ledger system. You've got to track all of these different particles of money now. So banks manage just like we talked about. Banks are frugal just like we talked about. They're not looking for things that don't cash flow. Okay, if you go into like the local banks, I don't know how they are in Cali, but if you go into a bank up here, like it's bare, especially where is it by Cliff's office? Is it North Rim or First National? It's like there's nothing in it, and it's just like it's kind of like this. It's just like you got your counters, you got your bankers' desks, and it's bare and empty inside. Because a desk doesn't produce income. They're not putting money into it. They're thinking about how do we maximize profitability. So all the stuff we're talking about tonight, these are practices of the top 1%. These are things that if you look at historically, they've been done over and over and over and over, and they'll continue to be done over and over and over. When cryptocurrency fizzles out, if it does, there's still going to be banks. When the company with your stock portfolio fails and goes under, there's still going to be banks. So you want to pick financial concepts that have been practiced not just decades, but for centuries successfully. So when we talk about the sacred account, when we talk about all of the things that we mentioned tonight, that's got a proven track record. It's not speculative. It follows all the rules that we need it to follow in order for it to be profitable. And it's something that if you follow, we guarantee A, you'll never lose money. B, you will always gain money. And C, you're going to reduce your taxes. And those are really the three things you want to focus on. How do I not lose money? How do I make sure I'm always consistently gaining? And how do I make sure that I reduce my taxes? Because that's an automatic rate of return. Okay. So that's the sacred account. And if you guys are watching online real quick, if you guys are watching online, if you've never heard about the sacred account, go to sacredaccount.com.